The triple bottom is one of the strongest confirmations that a downtrend has completely lost control. This pattern doesn't rush. It takes time to form, and that time is exactly what makes it reliable. The market tests the same support level 3 separate times, and each time sellers fail to push price lower. By the third failure, buyers are ready to step in. A triple bottom forms after a downtrend and is built from 3 main elements, 3 lows near the same level, and a neckline acting as resistance. Let's talk through the story step by step. The first bottom forms when price drops and then bounces. Sellers are clearly in control. The bounce feels temporary. Most traders still expect lower prices. Price then rallies to a resistance level and pulls back again. That resistance will later become the neckline. The second bottom forms when price drops again to almost the same level. Sellers try once more to break support, and they fail again. Some buyers begin paying attention. Price bounces again, but not with much confidence yet. The third bottom is where the message becomes clear. Price drops into the same support area one more time. And once again, sellers cannot push lower. No new low, no follow through, just rejection. This repeated failure is the heart of the pattern. One failed push can be noise. 2 failed pushes raise suspicions. 3 failed pushes confirm sellers' exhaustion. Here is a simple real-life analogy. Imagine trying to push a heavy box through a doorway that's slightly too small. You push once, it doesn't go through. You push again, it still doesn't fit. You push a third time, and now you're tired. At that point, you stop pushing. That moment is the triple bottom. Now let's talk about the neckline, because this is where the pattern becomes actionable. The neckline connects the highs of the bounce between the bottoms. As long as price stays below it, the downtrend is still technically active. But once price breaks above the neckline, the triple bottom is confirmed. That breakout signals that buyers are finally taking control. This rule is critical. A triple bottom is not confirmed until the neckline breaks. 3 lows alone are not enough. Now let's talk about the psychology behind this pattern. At first bottom, fear is high. At second bottom, fear remains, but selling pressure is weaker. And at third bottom, sellers are tired. When price breaks the neckline, fear shifts from buyers to sellers. Short positions get trapped. Momentum flips bullish. In smart money concepts, triple bottoms often appears during accumulation. Sell-side liquidity builds below equal lows. Institutions allow price to dip into that area multiple times. Each dip absorbs selling pressure. The third bottom often marks the final accumulation phase. This is why triple bottoms are commonly found in discount zones, major support levels, previous weekly or daily lows, or after long bearish trends. Now let's compare triple bottom with double bottom. A double bottom has 2 tests of support. A triple bottom has 3 tests. That extra test usually makes the triple bottom more reliable, but slower to form. Another important detail beginners often miss. The 3 bottoms do not need to be perfectly equal. What matters is that price repeatedly fails to break meaningfully lower. A small difference in the lows are normal and still valid. So let's make this very practical. Imagine price has been falling for days. It hits a low and bounces. Then it hits the same area again. Then a third time, each time selling pressure weakens. Once price breaks and closes above the neckline, the market has already confirmed the trend change. One common mistake beginners make is buying at the third bottom. That's risky. The pattern can fail. The correct confirmation is a neckline breakout, not the third low. Triple bottoms work on all time frames, but they are especially powerful on higher time frames because they reflect long periods of accumulation. Here is one final analogy to lock this in. Think of a ball bouncing on the floor. The first bounce hits hard, the second bounce hits again. The third bounce barely pushes lower. And then the ball starts rising. That rising move is the reversal. So, to summarize, the triple bottom is a bullish reversal pattern that forms after a downtrend. It consists of 3 lows near the same level and a neckline. It shows repeated failure to break support. The pattern is confirmed only when price breaks above the neckline. And in smart money concept, it often aligns with accumulation and sell-side liquidity grabs. The triple bottom is the market saying, we tried again and again and again, now sellers are done.